Anyway, just a little quick intro. Carter Thomas from TS Insurance Services. I want just to hit the presentation. I want you to actually, hey, I want to know a little bit more about Carter, how you got into the business and the family and the whole 9 yards, and why you chose the business, and maybe just like what you've seen being in the business as long as you have, and what you see going forward and all. And then you can kind of get into your spill if you don't mind. Full transparency, we use them as one of our carriers for our insurance. Great people, great people more than anything. So we enjoy doing business with them. But with that, I'll let you take it away.
All righty. Let's see here. I'll go into all that, but I just want to make sure, is the screen sharing and everything working, and can you all see me as well?
Yes.
Okay, cool. Yeah, so a little bit about me. I'm from Knoxville. Family's from here. Was born and raised here. And TIS was founded, it's an independent agency founded by my great grandfather, Norm Thomas, in 1945. And he worked there. I think he passed away in 59, and his wife worked there, and my grandfather joined in 64. And he's kind of built it up over the past 50 years into now we're, I think, the largest independently owned agency in Tennessee. And then when my brother graduated college, Kelly Thomas, who you all may have worked with some, he came here, and then I joined in 2018 upon my graduation from college. So we've been from Knoxville and kind of been reared in insurance. It was constantly talked about at the dinner table among our family, and it's kind of been the bread and butter of everything we've known and done. I went away for school, UVA, wanted to, when I went away, I wanted to leave Knoxville and come back, but I've found that there's no greater city than Knoxville. So moved back after graduation and joined the family business, and excited to be working, love working with my brother and uncle and granddad. So that's a little bit of a background. Anything else?
So is your father not part of the business?
So he worked here early on, and then he decided to go to law school, and so he was here for a few years and decided he wanted to be a lawyer. So he's a corporate lawyer for a company in Knoxville called Cellular Sales. So he's no longer in the business, but he was for a little bit, but wasn't for him. And he's been doing that for a while now.
Just curious.
So it's my granddad, my uncle, my brother. I've got a younger brother and a younger sister. I think my younger brother is going to come after he graduates from UT, and then maybe sister. She's at Ole Miss. She's younger. Don't really know what she's doing yet, if she wants to come or try something else. But that's kind of the backstory of everything.
Awesome. Thanks for sharing that.
Yeah, absolutely.
And TIS, by default, Thomas Insurance Services?
No, so it started as Tennessee Insurance Services, and then at some point, I don't know what year, we used to just be in Tennessee, and eventually just transitioned to TIS Insurance Services, because we now do business in 48 states, everywhere but Alaska and Hawaii. So it started as Tennessee, and then now it's just TIS.
Gotcha. Thanks.
Yeah, absolutely. Any other questions? All righty. So I've got a PowerPoint, and we've done a couple of these, and there's a couple ways to go about it. One, I could go through and tell you what coverages you need, your property, your liability, your umbrella. What we've found to be more valuable, whether you work with TIS or another independent agent, hopefully that agent's going to, recommend the proper coverages. So that really shouldn't be at the forefront. What you guys want to know is, when you're looking at properties and you see all the characteristics of a property, how is this going to affect my insurance? How is it going to affect the pricing? What do I need to look for? What are the insurance carriers looking for? What do they like to see? What do they not like to see? And there's some certain qualities that they hate and will not do, and we'll go through all that. But basically, this is the do's, don'ts, and maybe do's of apartment purchasing, and I'll just get into it. And if you all have any questions, we can do questions at the end, but as we go through, certainly feel free to stop me. Sound good?
Absolutely. Your show, man.
All right, so presentation at a glance. We're talking about the don'ts, the maybe do's, and the do's. So when you're looking at an apartment, there's certain things to look out for, and I've kind of got a list here, and we'll go through and talk about each one. But these are the don'ts to avoid, basically, when you're looking at a multifamily property, because carriers don't like them. They're either going to be ineligible or extremely expensive. But the biggest that we see all the time, that really, if you see these on a property, our advice would be just to move on to the next one. And I'm sure all of you have heard of these, are the Federal Pacific and Zinsco stab lock circuit breaker panels, which I think were manufactured in like the 70s and 80s on buildings. And basically that they've got a much higher fire risk than the newer panels. And really, we don't have any carriers that will do them. I've seen State Farm on a couple of properties that have these, and the only time I've seen them on it is when they're insuring them on an actual cash value basis rather than replacement costs, which means they're going to pay, if you have a loss, they're going to take the value of the building and then depreciate it however old it is. So you really don't get paid out as much. And a lot of times banks, I don't know any bank that allows actual cash value on the insurance, and they'll say no if you have an actual cash value policy. And that's the only policy that I've seen with the Federal Pacific. All of the carriers that we represent, and I'd say most carriers, are just going to say no immediately on this. And even if you get into a deal where you say, well, we'll replace them within the first 30 days, it's still very difficult on the insurance to obtain it, or extremely expensive. And I would recommend, if you've got a property that has these, just to move on, because one, even if we can find insurance, someone willing to do it, replacing those is extremely expensive as well. So I would just recommend moving on to the next opportunity. The next one is the fuses and knob and tube wiring. I don't know a ton about these. I was looking into it. They were put on apartments, and and electricians use them in like the 1880s to 1930s. So really a lot older buildings. But if you have a building with the knob and tube wiring or the fuses, I'd recommend moving on from that as well. The next one is 100 amps to each unit. And basically what that is if you look at the circuit breaker panel, it'll show on there that the ampage to that unit. And if it's under 90, the older buildings maybe had 80 or 90 amps. And that was when, you didn't have as many things plugged into the walls, and the electricity could handle, it just there wasn't a ton of stuff plugged in. And compared to nowadays, where you've got just everything in every room, your TVs, your speakers. So a lot of the carriers, if you don't have 100 amps, they will decline that as well. Any questions so far on the first three? Sometimes people say, well, if we do this, do you think it'll work? And usually these are the big no-nos on those. But any questions so far?
Hey, Carter, go for it and I'll jump in after.
Just a rough rule of thumb, if you were to try and, speak intelligently about how much it costs to insure like Federal Pacific or Zinsco, have you seen quotes recently or, ever where you see, okay, it's $1,000 a door, something like that, or 2,000 a door?
I've never seen the State Farm policies that have, and we don't represent State Farm, they work directly. I've never actually seen the policies that have insured those, how much they cost. As far as TIS and our carriers, there's not been one that we've been able to get a carrier to agree to cover it. That's why I say move on, because even if you're going to change them soon, carriers don't do them. Even you could say, we'll pay you $10,000 for a 10-unit place. And, they just, because in their eyes, they're saying, well, these have been such a problem in the past that even if we are on it for 30 days, well, the odds of something happening in that 30 days, even though it hasn't happened, ever, they see it as high. If it were up to me, I wish we could get, insurance on everything, but the carriers are trying to lower their risk. And in their eyes, the Federal Pacific and the Zinsco are just extremely prone to setting on fire.
Great.
Do you
Not a problem. So you're not even getting quotes. That's that's easy enough. So
Just move on.
well,
thanks,
do you
Carter.
remember? Do you remember though, Carter? In regards to Buffalo Ridge, you know, we got insurance. Content. I mean, we had insurance, but knowing we did have those panels to change out. Of course,
You
no
all
one
have
was
those?
living. No one was living in the building. We had 19 panels that we changed out because the
Okay.
buildings were empty. So we got some type of coverage, and I'm not disputing what you're saying. I'm just
No,
saying
no, and that I do remember
somehow.
that. You say that.
And if
And
you want to work out the rough math, we were probably paying 11 grand for 19 units. So if that gives you an idea, Ryan, of cost. You know, it's still up there because of the vintage
it's
of the
high.
building.
And that was when we worked on that in 2018, right? When they still had
2018 to 2019, we finished that building.
changing
Correct.
those. And even now, so another aspect that's affected the multifamily is these just huge property losses, like the tornadoes that hit Nashville, this water damage loss that hit Texas, where literally tons of pipes burst and flooded tons of apartments and homes and everything. And then you've got the hurricanes. And from when I started in 2018 to now, they say that it's called in the insurance industry, the market has hardened a lot, where a lot of carriers have decreased their capacity, meaning if a carrier could insure $1 billion worth of property, they may be able to now insure $800 million worth of property. So there's less coverage capacity limits available as a whole, which in turn is kind of like supply and demand. The supply's decreased, the pricing has gone up, and it's created this hard market. And when we were in 2018, it wasn't quite as bad as it is now. And we probably were able to convince someone to, stay on it with us for this amount of time. They'll get them changed. We'll send proof. Now we can't even, it's gotten so tough, the property market, that I worked on one recently and we weren't able to get someone to do it. Does that make sense?
Yeah. Is it a matter of pricing increasing so much that just by sheer numbers, their ability to cover it shrinks based on that example you just gave, $1 billion to $800 million? Or do you even see some companies, not necessarily based on the expenses, but hey, we're cutting back what we're willing to cover because we're also reducing our risk? Am I thinking about that possibly correctly?
You're totally accurate in that, because I heard before I was here that in the past 10 years, the insurance market has been very soft, where underwriters were trying to write anything they could. Everybody wanted to just increase their premium, increase their numbers. And as a result of that and aftermath, they got on a lot of riskier properties, riskier accounts. And now all these losses have been adding up. So it's definitely true that now they are much more thorough in what they look for. Every carrier now pretty much does inspections. And so they've basically, what it is, if there's a loss, the underwriter wants to be able to go to their boss and say, this is why we wrote this. We went through all these checklists and we agreed to do it. Whereas used to, I don't think they were nearly as strict on what they were looking for, because everyone just wanted to write as much business as possible. But now we're on like the next part of that cycle where everybody's seeing huge losses on doing that. So they've, like you said, have gotten a lot more risk averse and less willing to, maybe make an exception on an account or help out. So that's definitely a factor.
I think Fernando had a question.
Yeah, thank you, Kim. I did just briefly on the less than 100 amps to each unit. I live here in Denver. A lot of apartment complexes don't have any AC units. Majority of the high electricity typical use items tend to be gas instead. And so
Okay.
do you see in markets like that, having less than 100 amps is really common, that's not necessarily a don't? Just kind of curious on your thoughts there.
You know, in a situation like that, if you run across one and we can kind of give a story and say, look, that these are 90 amps, but there's not nearly as, you know, much power going to these. If it's a situation like that where it's unique and there's a story to tell, we can go to the underwriter and explain that. You know, even before, let's say it's just one are kind of talking about, you're not even under contract yet. And there's a story to tell, then we can certainly do that and see if they're willing to make an exception. That's just kind of a standard, but if there's more to it, then I wouldn't say for that one specifically, just to immediately go by. Maybe just call us and say, we're looking at this. It's got less than 100, but here's why, and here's why it's not a problem. Does that make sense?
Yeah, it does. Thank you.
Yeah. Any others? All righty. The next one is aluminum wiring that's not been remediated. And that the aluminum wiring was done in like I think 75 to 82 mainly. And when they say unremediated, it wasn't the wiring that caused problems. It was the connection to the breaker or wherever they were connecting the wiring. And remediating, it's actually not too tough. You have an electrician go in there and they change out the connection. But if it hasn't been remediated, then the carriers tend to stay away from those. But if you can show us that it's been remediated, or if you know you're going to do it within a week, it may be a little bit easier. But if there's no plans to change it, then I'd say don't on that. The next one is galvanized or polybutylene plumbing, and this is just a type of plumbing that was used on older construction buildings where there's corrosion that built up in the pipes, and carriers tend to stay away from that. So if it's got that and you know it's not been fixed, then I'd stray from that. And then the last couple here are pretty easy. Charcoal grills. No carriers want to see those on decks. So if you're going to take over, just plan to make either have in the common areas something in the middle of the field, but don't plan to allow tenants to have those on their decks, especially if it's wooden deck. And then pre-existing damage is a big one. Every time we fill out an application, there's always a question on there: does this building have pre-existing damage? And so if it does, the carrier typically either won't do it, or like I worked on one maybe 8 or 9 months ago, and it was a roof was in really bad shape, and I think a tree had maybe fallen on it. And I got a carrier to do it, but they said we're going to exclude the roof, or we're going to exclude water damage until the roof is fixed. So if it does have pre-existing damage, we may be able to get it, but there may be exclusions, or that could, if there was a loss, they wouldn't be covered. So that's one thing to look for. And if you come across one that has it, just call us or your agent and talk to them about it, and they can shed some more light on the impact of that. And then the last one is 2 means of egress, which is just 2 ways out of the apartment. So, or out of each room. So if it's got less than that, most carriers always want to have two ways out. And if they don't, then they tend to stay away from that as well. So those are kind of the big don'ts, as we talked about. There's a few on there that if you come across an apartment that pricing's great, but it's got one of those, just call us or call your agent and talk through it with them. It may be able to find a solution that makes it more into a yes option for you. But I'd recommend any of those. I'd recommend before you get too deep in the process, talking to the person you're working with on it and having a conversation, versus going down, getting under contract and all that, and one of these things throwing off the entire deal just because you couldn't get the insurance or it was too expensive.
I'm just going to make a quick comment. For most of you, you know this, but some people think, oh my gosh, I can't do that. My point is with Carter and Kelly, if you have something that's going on, especially in Knoxville, it's not too far of a drive, they'll come to the property with you even before you have it under contract. And you know what? They're doing that out of the kindness of their heart, and maybe they'll get the business, maybe they won't, but that's just the way they like to operate and service people. So it could save you a big headache. It may help you walk away from what you think might be an opportunity. So, and then once you get it under contract, they'll come on site doing due diligence and just kind of walk through things and make sure all the T's are getting crossed and I's dotted, things that this becomes part of your team, another leg of your team that you don't have to worry about it, and they do it for you. So just
Yeah.
throwing that out there for what it's worth.
Thank you. All righty, if there's no other questions on that, we'll go to the maybe dues. So these are things that could affect the pricing or make it tough, but they're not totally just no's, or they're less no's than the don'ts, and they're pretty simple. But coastal properties, naturally, they're by the water. Hurricanes, carriers tend to be a lot more expensive on those just because the exposure's a lot higher there on the water than an apartment in Knoxville, Tennessee. And similar to that, properties in wind heavy states, these are typically your like Texas is pretty bad for wind and hail. Kansas, the Midwestern states that are totally open are another. They're definitely not. It's impossible to find insurance. It's just going to be more expensive than somewhere like Knoxville. I feel like Knoxville and some of the areas like Kentucky, pricing's a little bit better than, if you go to Kansas or Texas. I keep saying those specifically because we've worked on some there where the pricing's just been expensive because of the wind. Or what they can do is you can get pricing, but they may say, you've got a $2,500 deductible for fire or theft or something like that, but we're going to give you a $10,000 or a 2% deductible for wind, which makes the pricing more competitive. But if you have a loss, your deductible is a lot higher. So those are two to look out for. Another one would be rural properties. Naturally, if you're far from a fire station or kind of out in the middle of nowhere, it's a little bit more expensive. Sprinklers help if that's the case, but I tend to see when we're specifically talking about multifamily, those tend to be, around not nearly as rural. They're around, grocery stores and things like that, but that's another thing to look out for. Any questions so far on the maybe dues? First three are pretty self-explanatory. Same with the fourth. Old properties prior to 1970. This has a lot to do with the don'ts that we looked at before. A lot of those on the don'ts are older construction. So when you get into 1990s and newer, it makes it a lot easier from an insurance standpoint, a lot more price effective, because carriers just know that a lot of these issues that construction did in the earlier decades have been, they've realized that they're issues, and states and cities and municipalities won't allow them anymore. So that's just when you're looking at older properties. And I know from an investment standpoint, or from a real estate investment standpoint, the idea is to buy one that's less expensive, which tends to be older, go in there, fix it up, and then you can increase the value on it. But it is, from an insurance standpoint, when it's a newer property, it makes it just less expensive, and it's easier to you get more carriers that are willing to write the insurance, so you can get the carriers competing with each other. So it just makes it, from an insurance standpoint, more favorable when they're new properties.
Hey, Carter, there's a question from the chat. What about septic systems?
Let's see here. And when just having septic systems in general,
I believe that's, yeah. If your property, your multifamily property is on a septic system, what does?
Okay, yeah. So having septic systems, I've never run into an issue with that. If it may be if it's an older one and the septic system is outdated, that they wouldn't. There's one I worked on maybe a month ago where, when we started working on it, someone had gone through and totally updated all the septic systems and everything. So that wasn't a problem for me. So if it's older and has those, if they're not in good shape, it may be a problem, but just having them in general is not a problem. Any others?
I don't think so.
All righty. The next one, willingness to fix hard don'ts. And this kind of goes along with the next one, pre-existing damage. If sometimes we can get a carrier, like we were talking about on Darren's, if you can go in there and fix it within 30 days, may be able to convince them to do it. The best way to go about is if you can negotiate with the seller to fix something that's a hard don't prior to the actual closing, then that makes it a lot better, because when the new carrier's on it, it's already fixed. You don't have to convince them to stay on or to come on it for 30 days. And after 30 days, they're going to want proof. And if it's not done, it can cause problems. So the best way on the fixing the hard don'ts is trying to negotiate that prior to the closing. But if I know that's tough to do. And if it's impossible, then again, just talk to us or your agent and just let us have a conversation with the underwriter and try to work out a deal where they're willing to work with us and you guys. And then lastly, maybe do high crime areas. The carriers have all these statistics about cities and crime zones and things like that. And naturally they're less excited to write an apartment that, is in a part of a city that has high crime areas. Doesn't mean it can't be done, but may make the insurance more expensive. And that's another one. Just talk to your agent on it and see.
Carter, quick question on that last one, high crime areas. Can you comment to the statistical companies that they generate or websites that they may look at, so we could look at something similar, just some guidelines on that, or do they have their own proprietary stuff that they pay for?
I would say that I don't know the answer to that. I don't want to try to come up with that. There's one carrier in specific I'm thinking of that they'll say like this was declined because of the area it's in. I'll reach out to them, and any questions that I need to follow up, I can get with Darren on how to get those to you. But I'll check on that and see what websites, if they have their own or if they look at something specifically, and I'll get a link to that and have Darren send that to you all.
Thanks, Carter. Appreciate it.
Yep, absolutely. Let me write that down real quick. All righty. Any other questions on the maybe do's? All righty. And then let's see here. The last one, these are just pretty self-explanatory, but it's going to make the most favorable pricing. It'll be easy to get multiple quotations on. It'll be less of a headache for you guys trying to go out and figure out, when was the roof updated? Has there been any updates to HVAC or anything like that? So newer construction, really anything built newer than 1990 is typically going to be pretty favorable. If it's newer than 2000, aim for that. But 1990 and newer, there's not been many, construction defects that cause a lot of problems after 1990 from my experience. Properties in low hazard areas, if it's in a good part of town, not a lot of crime, another favorable pricing standpoint for carriers. Sprinkler buildings, obviously, the carriers prefer those, and it makes the pricing a lot less than non-sprinklered. Well-run amenities, they just like to see things being taken care of, and pretty self-explanatory. Non-combustible construction versus wood frame buildings. The non-combustible would be like if the building was built entirely metal. That when you go in and rate these, you put in the construction type on it. So if it's non-combustible, the rating is going to be less expensive than if it's a totally frame wooden building, just because less prone to fire. The next one, no losses for prior owner. It's not necessarily, it depends on the carrier. Sometimes when we're working with carriers, they may say, even though this is a new purchase for Darren, we want to see the current owner's loss history and review those before we do it. They don't always. There's some carriers that'll say, okay, this is a new person, new management, totally new. We're just looking at it going forward. However, some do want to see losses for the prior owner. So if the prior owner does not have any losses, that'll be a plus in the pricing. And then renter's insurance, we recommend that you require for all your properties that every tenant carries a renter insurance. That's going to one, protect their personal property, but it carries liability insurance. So if they're liable for something on the property, and you all are brought into a lawsuit, theirs is going to kick in first. And so we recommend that all tenants have renters insurance. And then the last one, high-end tenant base. And saying that, I'm not saying go to, the nicest neighborhoods in all the cities. That would be, from an apartment standpoint, those apartments are nice, but more just people that, take care of their cars, take care of their apartments. And, you can kind of tell when you look at an apartment complex that if really, when I think a good way to say this is, if you're going to look at an apartment complex, put yourself in the shoes of an underwriter for an insurance company. And when you do that, you can have a sense of, oh, this is a good risk, or, oh, this may be a little bit tougher, or want to dig more into this one. But those are kind of the things to look for on when you're looking for a property that are going to be favorable to the underwriters and to the pricing, and make the insurance just process easier. Any questions on any of those?
Yeah, Carter, on the no losses for prior owner, is there like a sunset on that? 2 years, 3 years, as far back as the
No,
goes?
they typically, it depends on the carrier. It's usually 3 to 5 year prior loss runs, currently valued loss runs. So they'll want to see, when I say currently valued, like the run date on those loss runs, they'll want to see, in the past maybe month from the purchase. That way, any open claims are totally updated. A big issue that they don't like is if, let's say, a tree fell on an apartment, or not, let's say there was a liability claim on an apartment 6 months ago, and somebody fell in the parking lot and they sued, and that claim is still open. A lot of times it's tough for a new carrier to want to come on there when there's still lingering issues, but it just depends again on the carrier if they do require the loss runs from the prior owner. But to answer your question, it's usually 3 to 5 years.
Okay. Thanks, Carter.
Yeah. Any other questions on those? So if there's any questions about anything we talked about in general, happy to answer those, or comment on anything. But if not, those are kind of, when you're in the search for a multifamily property, what to look out for, what to pursue, what maybe you should talk to your broker before, getting too deep into it, just to make sure that, the insurance isn't going to cause you an issue on the road.
I got a question for you, Carter. Maybe a comment first. We were looking at a property. I think it had aluminum wiring or poly. Might have had both. I don't remember. But we got in conversation with some other owners that had a similar situation, and when they got their insurance quote back, it basically wrecked the deal.
Yeah.
What he was able to do was come to a solution where the agreement was to remediate whatever it was, and they would re-quote after a year or something like that. But also the insurance company wanted that first year premium guaranteed. In any case, it was something that was able to be worked out. So, if you've got just poly, or maybe just the Sylvania panels, it might be something that you can work through. Don't just completely say no and move on. For one item, if you got items stacked that are going to be working against you, it's going to be harder, but there might be a workaround by getting on the phone and, like you said, telling the story of it, or
Right. Yeah, definitely. If it's any of those don'ts, and like you say, if there's a bunch of them, it'll be tough to convince any of them. But if there's one of them and there's a story, and you all have a plan on how to fix it, then definitely call and talk through that. But if there's no plan to fix it, or if you don't think, if you think it's going to be expensive, and you can say that, yeah, we'll have this done in 30 days, but, or, in 6 months, but realistically, that that's probably not realistic. I would stray from it because the carriers follow up with us constantly. I got an email the other day, not on a multifamily account, but it was on something else. Someone was supposed to install something, and by the end of February, and underwriter reached out to me and said, I need pictures of this, like send this, or we may have to come in and relook at everything. And so they're constantly following up with us. So if on something like that, if you're going to plan to remediate it, try to, stick to those plans. And if you think it's going to end up causing too much problems down the road, it may be good to move on. But again, like you said, talk through any of the issues first. You don't just have to say no immediately. Call and talk through it, and we'll be happy to talk to the underwriters and see if they're willing to work with us and work with you guys to make it work. But like you said, the pricing, even if they have that, they may still charge a lot for the pricing in the first year.
And then one other thing is, I don't want to ask you to quote, potentially premiums across the entire United States on 1 hour phone call. But if you're either new to underwriting or have been underwriting for a while and haven't necessarily landed a deal to get that hard quote to know what your market rate might be, if my rule of thumb for the past year has been $300 per unit in my market, should I be rethinking that? And would you give any guidance as to, just kind of generally what you've seen the increases be? Should I up my rule of thumb by 20% moving forward or something like that?
That's a good question. I do think, 300, and there's so many factors that it depends, because, brand new construction, they may be able to get them for 200 a door. Older apartments with issues, maybe 600 a door. So, average, there's just a ton of factors to come up with an average, but I think $300 a door, if the property seems to be in good shape, if it's, a little bit older but doesn't have these problems, is a good estimate. I will say that, and I don't know where the market's going right now, but I will say that whether it's apartments or shopping centers or anything, that a lot of the carriers, and it's made it very frustrating on our side because people get frustrated, but going back to the conversation about the hardening market on the property and there just being less capacity available, we have seen on the property side prices going up on renewals and even new business quotes, where we're coming in there and trying to gain business and bring business to a new underwriter. The prices are higher than we've seen in the past, and I don't know if they'll continue to go up. The insurance market, just like the stock market or any type of market, is cyclical. So, the past 10 years, it's been pretty easy to get insurance, and now we're kind of back on the upward trajectory of that. And it's a frustrating reality because it causes a lot of problems throughout. It starts with the insurance, and that trickles down to, if the insurance doesn't make something work, then it totally makes a deal not work. And so I would say in going forward that the pricing is going to be higher than maybe you've seen on apartments, whether it's I don't even know. It just seems to have gone up this past year and a half, and everybody blames COVID for everything, and the insurance companies are not unique in that they're saying that COVID, even though they didn't pay any business incomes claims, they're saying that COVID's caused them issues. And it's just, I'd say in the years to come that the pricing that you'll see on your apartments is going to be more expensive than you're used to.
Well, would you say that if I was in Texas, and most of us run pro formas at income is going up 3% a year, expenses are going up 3% a year.
Right.
Would it be necessary in some markets to separate your insurance out of your P&L and say, this might go up 5 or 7% a year for the next little while, and look at it as a different line item? Because as a region, you just got hammered.
Yes. as far as that, I would not use 3% for the insurance, even on whether it's multifamily or anything. A lot of the accounts that we've seen this year specifically, the renewal carrier has come in. I don't think we've had hardly any flat renewals this year, which people are used to. I think most have been in the high single digits to low double digits on a clean account, meaning you
Okay.
haven't had any losses. I had an account probably 6 months ago, again, not a multifamily account, but just an account that had a high property exposure, but not terrible losses. The carrier came back at 44%. And I was like, what do you expect me to do to this? And so the carriers, it's almost to the point where it's like, they don't even care to lose the business, because to them, less business is less risk. It used to be more business is more money. Now it's less business is less risk. So for the insurance, I would certainly, I wouldn't think that a 8 to 10% year over year would totally be outrageous when doing the pro formas.
I was really enjoying this call until about 5 seconds ago.
It's frustrating. It makes our lives a lot easier when it's like the market where everybody's wanting to write the insurance. But even, I mean, we've seen, I don't know how familiar you all are with the insurance markets. You've got your standard direct carriers who we work directly with. So we talk to the underwriters, and then for really tough to place risks, there's what's called the E&S, or the excess and surplus lines market, where we work with a broker and then they go to underwriters, and they're supposedly here for tougher to place risks. And this year alone, we've gotten more just them saying, we can't even get this done. It's like, it's not that we can get this done, but they're going to charge, a $3 property rate. It's that we can't even get anyone to cover this, because that capacity is so much less than it used to be, that underwriters are so particular about on what they will cover, even in that more difficult to place market. So it's just, and it's a little bit morbid talking about, but the way we've seen the market shift the past year, it's made things challenging.
It's
Yeah,
quality
well-
over quantity. Sounds like it.
Yeah. And I wish I could tell you it was going the other way, but I'd rather you all know that going into it, that it's just a different beast than it was, 2 years ago, 3 years ago. And if you've been in it longer, the past 10 years.
Do you see anything in the industry? So I'm ignorant when it comes to the insurance industry. The state farms, the Allstates, the farm bureaus, name the insurance company that most of us common folk are familiar with, where we go get our homeowners, our car, blah, blah, blah. We come to you for multifamily and others like you for multifamily.
Right.
Are those companies now seeing an opportunity to insure multifamily, whereas 2, 3, 4 years ago they weren't doing that? Or I'm totally just asking
No, you're fine.
in the dark question.
Other than state, so the kind of, you're talking about these direct markets that everybody's heard of, that State Farm, Geico, that don't work with the independent agent model. They have their own agents and go directly to the property owners or the people. Really, the only market of that I've run into is State Farm, and I've seen them on like the Zinsco ones a couple of times. I've seen them on some other apartments, and it just kind of depends. A lot of times I've seen them on apartments with this actual cash value versus replacement cost. I don't really know at this point their plans, because we don't work with them. So maybe they do have plans to try to come in and get into the habitational apartment industry. But in general, that industry has been known for large losses due to fires. And so there's not a lot of carriers in the first place that will do it. And those that will, but it's kind of constantly in and out. We've seen, Middle Oak is a company that we've worked with and worked with Jake and Gino on. Well, Middle Oak's coming out of the Tennessee market. So carriers are always, especially in the apartment industry, constantly changing their, appetite and what they'll do. So it could be that some of those players will come into the habitational market, but I just don't know that because we don't work with them directly, and I haven't heard anything whether they are or they aren't.
I've got a question, Carter. And then first to follow up, Darren, what you're saying, quality over quantity. We managed to get a quote from Kelly, right? At $230 a door on a newer build.
Okay.
Right? So just to give you an
Nice.
idea. So, and that was in North Carolina. So significantly cheaper there than what I'm seeing on a lot of the older construction. That was this year.
Right.
The question for you though is, if I have master metered electric, is that something that the insurance companies look poorly on? Just because now we're talking about very large amperage, thick wire and large breakers, or not so much?
In all the experience that I've had doing these and filling out applications, I've never had anything come up on master metered. I've never heard a carrier say that they were against that or that was a no-go. So I don't think that would be an issue.
Okay. Good to know. Thank you.
Yeah.
What about like forward looking, going back to the Sylvania panels and polybutylene? I mean, these things came on, they were being used. Obviously, at some point, there was a problem identified. And I think over time, and correct me if I'm wrong, insurance keeps an eye on it. When they see that it's creating a bunch of losses for them, at some point, they just draw the line and say, we're not going to go into this. We're not going to insure this product basically anymore. So, a bunch of stuff being built in the 80s with the sewer lines. Everybody's, that's like the next big thing that they expect to be a huge CapEx item. Is there anything looking forward that is on the insurance industry's mind that over maybe the next 5, 6, 7 years, they might lose their patience with and just refuse to insure them any longer? So I might be buying something now that might be more difficult to insure over my hold.
There's nothing that we've seen particularly where some care. I'm trying to think if there's. I mean, I totally understand your question. Let's see here. I was going back to the don'ts. So as far as other items that may be a problem in the future that aren't now, I don't know specifically. There's not been, carriers that say, other than some of the things I've really kind of hit on here, everything that they've talked about or kind of talked about. But as far as other construction issues that happened in the earlier years, I don't know any specifically that in the next, 5 years, they may start saying, okay, that's totally outlawed. And if we start to kind of get word of that, I'm certainly will share that. But at this point, I don't know of any, anything other than we've talked about on here that they, 5 years from now may just say, we're not going to do that anymore.
Okay, cool.
I'm sorry, I don't have a better answer to that.
No, that's fine. That's.
So maybe that's a good
over time.
Yeah, nothing else comes up, but these are the kind of the main ones that we see that they don't like.
Hey Carter, if I'm actively pursuing a property, submitted LOI, and then sign the PSA, and then you have, for example, 30 days due diligence and then 30 days to close, so 60 days total. If something happens on the property, on like day 27 or 45, a pipe breaks, a fire or a tree falls on a building, how is it? And I would assume at that time, there's been no contract signed with an insurance company until it closes. What happens? I've never bought a property, and I've heard somebody comment on that. How does that work?
If let's say you're buying a property, 60 days out, you go under contract, we're 45 days out. We reviewed the quote and everything. Everything looks good from the insurance standpoint. 30 days in, something like that happens. If we've got the quote and between that point, something happens that was not made known to the insurance carrier, we're required to tell them. And it may depend on the issue. They may be fine with it. But if that does happen, you know, if I'm a purchaser and there's an issue, well, and it's going to take a long time to fix it, I would, you know, use that as a bargaining chip with the seller. Say, one, I don't want this on my insurance. Use your insurance to fix it, and then we'll talk about buying it. And then they're going to cancel their insurance anyway. So maybe it delays the the closing. The seller probably, because that happens, knows it's going to be tougher to sell. So I feel like it gives you all some negotiating power. But if you just say this happened, we still want to keep everything as planned, and then we'll just fix it when, you know, we close, it's probably not the best way. It's probably not in your best interest to do that. It's probably in your best interest to you know, put it back on the seller, because it happened when they own it, and come up with an agreement. And if for some reason this is your dream property and it's something that you can fix, just let us know. We can talk to the carrier and say this happened, but here's their plan for it. It may affect pricing, or it may affect, depending on what it is. The carrier may say, well, we were like on the roof example. If a roof started leaking, they may say, well, okay, well, we'll keep this in place, but we're going to exclude water damage until they fix it. So it'll just kind of depend on the situation. But if I'm purchasing a property and that happened while the seller is still on it, I feel like it gives me a lot more leverage.
If the seller puts the claim on their insurance and then, you know, sells the property and they cancel their insurance, does the insurance company then, does the insurance company continue and process to completion that claim, on behalf of the seller, or can they cancel it and say, no, you know, you've canceled your contract with us on, you know, right here, you know, as soon as you sold it, we're not dealing with it anymore, and kind of leave the tenant or whoever there is now has no direction to go, or are they required by law to complete that claim?
So if there's two types of well, that would be a liability on a property. If let's say there was a claim that happened on January of 2019, and you purchased a property, you know, January of 2020, and we didn't know about that claim. Let's say it was some underground or, you know, basement water pipe burst. It's something that nobody knew about until years later. The policy that was in place when that occurrence happened, when that claim actually occurred, the date it occurred, that policy is going to be responsible for paying that claim. So unless the carrier that was on it when that claim occurred is totally gone out of business, then they're going to be responsible for handling that claim, for processing it, for getting everything taken care of. So it doesn't matter if, you know, that policy's been canceled. You can still go back and turn a claim in on someone that's happened after a policy's canceled.
Gotcha. Thanks, Carter.
Yep. Anybody have anything else?
I've got one more, Carter. At what point do you start looking at kind of a blanket insurance policy where instead of quoting out, you know, building by building, you start quoting out an entire portfolio?
Yeah. When looking at that, and it kind of depends on how you structure your, you know, setting up each deal. If you've got two properties, it makes sense to put the two properties on a master policy. Let's see here. One thing has to occur to be able to do that. There's got to be what's called combinability. And that means, let's say my brother and I are going to purchase a property, and we insure it where he's 51%, I'm 49%. And then we decide to purchase another one where I'm 51%, he's 49%. we couldn't put those two properties together. That would only be able to, we would only be able to do so if I was 51% or more on both properties. So if you are going to do a master policy, there's got to be what's called combinability between the entities that you put on there. Maybe you have one entity that buys 10 properties, then that you'd have no problem there. But if you're creating a new entity for each property and the ownership changes on each entity and you're not 51% on all of them, then you can't really do the master policy. But if you've got two properties and let's say you bought them both personally or both in the same entity or have common ownership of the two entities, then I'd recommend at least looking at an option with both of them or however many of them on a policy. Does that make sense?
That does, yeah. I really appreciate that.
Anything else?
Yeah, I would just make the comment like your don'ts list and your maybes list. These should all be, top of mind just in due diligence when you're looking at properties, because it may not only be insurance that you have to get on board. It may be lending as well. Some of these are checklist items for lenders. So the sooner you find out this kind of information and even before you can get an LOI and you can clear this with your potential lender or insurance and kind of set up what your hurdles might be well ahead of time. But there's a lot of crossover between the lender's appetite for some of this stuff and insurance, not surprisingly.
Yeah. And I'll send Darren this PowerPoint. You're welcome to share it and send it to anybody to use.
Awesome. Anybody else have any questions? Good stuff, man. What I love about what you guys do is I've learned a lot in the last 3 years of both investing in multifamily, but you're always learning. So
I appreciate you all having me on there. You all can get, I put my cell phone number on that PowerPoint. Anybody's welcome to reach out to that anytime. If you have a question, I'm happy to answer anything. You all can have my email, all my contact info and the PowerPoint, but I appreciate you all letting me come on here and talk about what to look for when you're getting an apartment, because if you kind of follow that guidelines, it makes our job easier getting quotes and it's good things to look out for that makes your all's job easier in terms of, getting your pricing and your pro formas together. So use that. If there's something that you want to talk more about, please feel free. I'm happy to talk on the phone or anything, answer any questions. You can text me, totally available.
Oh, I have another question though.
Yes.
Is that all right? Well, with potential 5, 6, 7, 8, 10% increases year over year, is there an opportunity to write longer policies to lock in a known rate for a longer period of time?
There were some carriers that did that years ago. I have on property, at least, I have not seen a more than annual policy. Really in my time here, pollution policies, which don't really are important to you all, are policies where they tend to do a 3-year policy. But from a property standpoint, I think the carriers really see that as too much risk to get into a 3-year locked rate. And so we don't, even if they increase the pricing, we don't have any carriers that are going to do the 3-year rate. There may be 1 or 2 out there that might, but I don't have any.
All right, everybody go back and adjust their P&Ls.
Thank you, guys.
Yeah.
Yeah, thank you, man. Appreciate it.
Yeah, absolutely. Y'all have a good night.